Good morning, everyone. Welcome to our autumn tax update. My name's Aaron Hemmington, a tax partner in the Northampton office of Hawsons. So, after many months of speculation and crystal ball gazing, the Chancellor has finally delivered the 2025 budget. After increasing the tax burden by some £40 billion in her first budget, Rachel Reid has increased the tax burden by a further £28 billion in her second budget for a number of tax raising measures. And today we'll be guiding you through these. And to assist me with that, I'm joined by my colleagues Stephen Charles, Charlotte Owen, Gareth Davis, Ben Harris, and Ben Peacock. Um, Please note we'll be holding a Q&A session at the end. So if anyone's got any questions, please submit them using the Q&A functionality. Please feel free to do that as the webinar progresses. We'll also be recording the webinar, so if you need to leave early or just want to go through it again later on, it'll be available on our website. Okay, so for those of you that are new to Hawsons, we're founded in Sheffield as an independent partnership in 1854 and have remained independent ever since. Operating for three offices, Sheffield, Doncaster and Northampton, 12 partners and over 100 staff, and also a member of HLB International Network, which is within the top 10 of the accounting international networks. Focus on delivering accountancy, tax and audit services to privately owned businesses and their owners. The aim of becoming trusted advisors to those clients. Also provide financial planning services and cybersecurity services through Hawsons Wealth Management and Bruce and Butler. Again, just a recap on our services: audit, advisory, corporate finance, assisting people with business sales and acquisitions, taxation, compliance and advice, wealth management, as previously mentioned, as well as payroll services. So comprehensive suite of services there that we provide. Okay, so today's agenda, we'll be kicking off with corporate and business tax, and Gareth Davis is going to be guiding us through that, followed by Ben Harris with capital taxes, VAT and stamp taxes, myself with IHT, Stephen is going through the employment tax changes, Charlotte on personal tax, and Ben Peacock, who's recently joined us as a senior advisor in HWM, is going to be looking at sort of financial planning aspects of some of the changes. So without further ado, I'm going to pass over to Gareth Davis, who's going to go through corporate and business tax.
Thank you very much, Aaron. Thank you for joining us, everybody. And as Kenny Badenoch said this week, thank you for letting us interrupt your Cheerios with this frightening message about tax. A little bit slow on the slides. There we go. Right. First slide. Corporation tax rates. So no changes here, as expected. There's no changes expected for the rest of the Parliament, but time will tell on that. So if you're a company with profits up to 50,000 or less, 19% CT rate. If you have profits over 250,000, a 25% CT rate applies to all profits. And if you're in between 50 and 250, there's the marginal rate that applies that falls somewhere in between 19 and 25. All of these thresholds or rates are divisible by the number of active associated companies. So companies that aren't necessarily in your group, but are under common control. But it does include the group companies as well. So it's group and associated. Capital allowances. 100% full expensing, that remains in place. On qualifying expenditure, it remains permanently available on most types of new and unused plant machinery, excluding cars. The annual investment allowance remains in place at £1 million until further notice. There is a new 40% first year allowance that's coming in from the 1st of January 2026, claimable on new assets purchased for UK leasing and new plant purchased by unincorporated businesses. The new 40% FYA is good news for leasing companies. That's companies who acquire assets to lease out to customers. And it's also good news for unincorporated businesses because they couldn't claim the FYA before. Although the 40% FYA will mainly benefit larger non-corporates and mixed partnerships who have corporate partners. because the more generous £1 million AIA remains available to most non-corporates, and the majority of non-corporates that can claim the AIA would probably look to claim that first before thinking about FYA, mainly because of the higher risk of balancing charges when you claim FYA compared to AIA. The new FYA is not claimable on assets purchased for leasing assets overseas, and it's not claimable on cars. However, there is the other existing 100% FYA for new zero emission cars that remains in place. And that's my next point, actually, I think. Yeah, there's an extension to that 100% FYA that applies to new cars with zero emissions, as well as plant for electric vehicle charging points. And that offer is extended until spring 2027. So it's been extended by a further year. Next, there is a reduction in the writing down allowance claimable on main pool capital expenditure for all businesses. That rate was 18% and it's now dropped to 14%, and that's from April 26 onwards. And there's also the writing down allowance claimable on special rate pool expenditure that remains at 6%. Integral features generally includes electrical, lighting, heating, cooling, ventilation, and water systems installed within buildings, solar panels, and there's a small handful of selected other assets that qualify for the special rate pool. Loans to participators. There's a 2% increase in the rate of the Section 455 tax chargeable on loans to participators of closed companies. Just quickly recap. Participators are individuals that are shareholders or share option holders that are individuals, as well as individuals that are loan creditors of a company. Those are your participators, and your closed companies are controlled by 5 or fewer of those participators, or any number of participator directors. Section 455 tax applies to loans advanced to participators that are not paid back to the company within 9 months and 1 day following the period of advance. And because of the change in the upper dividend charge, Stephen, you've raised your hand. was that deliberate? Maybe not. Sorry. Because of the change in the dividend upper limit from dividend upper rate of tax, income tax, increasing from 33.75% to 35.75%, that effectively causes the increase to the Section 455 tax rate applicable on these loans. Large and multinational companies. Quick recap on the transfer pricing rules. UK transfer pricing legislation applies to the following organisations: companies or groups with more than 250 staff, or companies or groups with less than 250 staff, but have both annual global turnover exceeding 50 million euros and a balance sheet total exceeding 43 million euros. Qualifying organisations are required to account for their transactions with connected parties using the internationally recognised arm's length principle. A little bit of interference coming in. Can we get rid of that? It's not on mute. The arm's length principle generally is making sure that companies trade with each other in their group as they would do with third parties outside of their group. So, making arm's length profits, conducting arm's length transactions. The reason we're talking about this is because there's a new exemption that's come in, or is coming in, that effectively simplifies or exempts companies from some of the transfer pricing rules when they're conducting transactions with their other UK companies, conducting transactions with their UK group companies, where there is no risk of tax loss. The simplification will remove the need for UK companies to calculate transfer pricing adjustments in relation to their transactions with other UK companies. This is on the basis that the profits that are being added to one group company from making this adjustment are equal and opposite to the reduction in profits in the other UK company. So it ends up being tax neutral from a a UK tax perspective, and the government effectively ruled that unnecessary because it is basically just moving deck chairs. So it is good news because some of the common transactions that will be affected by this are UK group companies making long-term financing arrangements, loans between each other, and having to impute interest in both companies. Shouldn't need to do that anymore. And there's also occasional intra-UK group company management charges, which will hopefully also drop out from this. It says there, the change comes in from accounting periods starting after 1st of Jan 2026. There's also some separate plans to require multinationals to submit an international controlled transaction schedule to HMRC to report information annually on cross-border related party transactions. The ICTS is expected to affect accounting periods beginning on or after 1st of Jan 2027, so not just yet, but soon. And our understanding is that it is going to come in. Technical consultation on its design will take place from next spring onwards. Final slide from me. Bit of administration and simplification. So the corporation tax return late filing penalties will double for returns submitted on or after 31st of March, actually after 31st of March 2026. So the current penalties are, if you submit your return late, it's £100. That's now doubling to £200. The subsequent penalties for increasing degrees and frequencies of lateness. The maximum penalties were £1,000. They're now doubling to £2,000. That's as bad as it will get. And the reason for this is because these penalties, the original penalties, were introduced in 1998. They haven't increased ever since. So HMRC, the government, are attempting to increase these penalties broadly in line with inflation to penalise people in a more relevant amount of money for non-compliance. That is all from me. Thanks very much. And now next is Ben Harris. Thank you.
Thanks, Gareth. Thank you everyone for coming along today. Just get control of the slides. Excellent. So hopefully my screen doesn't freeze like the income tax thresholds today. I want to start by talking off about the mansion tax. So according to the government, the average B&D council tax band was actually paying more than those in Westminster from certain properties. So what they've sought to introduce is this high value council tax surcharge. And from the 1st of April 2028, this is going to be a new annual recurring charge of owners of residential property worth £2 million or more. And what this introduction means is that there's going to be up to now 10 main taxes that everyone has to consider when owning property. The charge is going to be based on updated valuations to identify properties above the threshold, and it's going to be in addition to existing council tax. It's going to be levied on property owners and not those occupiers. And it seems to be there's a lot of mirror imaging to the annual tax on envelope dwellings. So we'll see, when more guidance comes out, if it works on similar principles as well. And this is going to impact a lot of asset-rich, cash-poor individuals. So we'll see if there's any sort of deferral arrangements available for them as well. And the government is also consulting on a full set of reliefs and exemptions, as well as proposed rules and more complex ownership structures. And potentially if there's any sort of reliefs there regarding companies and then letting as well. The charging structure is there on the screen. So it's going to be from 2,500 all the way to 7,500, depending on the property value. And the property is going to be revalued every 5 years, similar to ATED. And from 2930, charge is going to increase in line with inflation as well. So that's something to bear in mind, that these won't be fixed charges. Now I just want to go on to EMI schemes. So EMI schemes are a very useful way of retaining key employees, as well as promoting growth of the company as well. And it looks like the government wants to incentivize this growth further by sort of opening the pool of companies that can now actually take part in the EMI regime. As you've seen there, they've significantly increased the limits there. So you've got the employee limit, for example, that's gone from 250 to 500. Now, on top of this as well, what they've also extended the exercise time available from 10 years to 15 years for EMI contracts granted on or after the 6th of April 2026. And those limits are also to do with that new time frame as well. But existing EMI contracts can be updated for this 15-year time limit as well, as long as they haven't expired or been exercised. You got to be really careful though how you're going to amend those contracts. So we always sort of recommend getting key advice, and we'll find out more as the rules come into play. The painful EMI notification requirement as well can be removed from April 2027, which is very useful for a lot of companies. So I've reduced the administrative burden on these companies for taking part. Venture capital trusts and EIS schemes. So there's been an increase in the existing annual lifetime and gross assets limits for those companies that are receiving investment under the VCT or EIS schemes. And you can see there the limits there. So for example, the annual investment limit has gone up from 5 million to 10 million for normal companies, and the knowledge investment companies has actually gone up to 20 million pounds. Now, one of the main points that came out of this was that the VCT income tax relief has actually been decreased from 30% to 20%. The government say that they've made this reduction to sort of better balance the reliefs available between VCT and EIS. So EIS doesn't get the dividend relief that VCT gets. So for example, dividends from VCT are exempt from income tax, as are the shares are also exempt from CGT as well. And I guess this has to just kind of be balanced with the loss relief that you do get from the EIS scheme. But we'll see if this sort of reduces the appetite for people to get involved with higher risk solutions with the VCT on the basis that they're not going to be obtaining as much relief available. EOTs, this was a big announcement that I don't think many people expected. So an EOT is a trust established for the purpose of holding shares in the company on behalf of the employees. Now, previously, if the conditions were met, the seller could sell their shares in the company to the EOT free from capital gains tax. Now, originally, the government thought the policy would cost less than 100 million in 2018-19, but forecasts predicted that by 28-29, this could actually increase to 2 billion. So now they thought we need to bring in some rules into this. And the new rules are that for disposals made to EOTs on or after the 26th of November 2025, 50% of the chargeable gain will be immediately chargeable on the seller. And importantly, that this disposal is not going to be eligible for business asset disposal relief or investors relief. So this is going to give an effective tax rate of about 12%. And then that remaining 50% gain is going to be held over and deducted from the trustee's acquisition cost. And this gain will come into charge later on when the trustees dispose of the EOT or if there's a deemed disposal at some point in the future. Now, this might make the relief less attractive, but it's still a very important relief, especially those who want to hand over the business to the employees. When we're dealing with EOTs, we deal with a lot of deferred consideration. Now, because this gain is now going to come into charge to capital gains tax, there's going to have to be a lot further thought about how the funding is going to be paid, how the funding is going to affect the transaction, especially if the seller now has to pay the CGT on half the gain. Other notable points. So the CGT rate for BADR and investors relief is still going to increase to the lower CGT rate of 18% from the 6th of April 26. We're already aware of this, but it's a good reminder. The government's going to be amending the non-resident CGT rules as well, including changing the definition of UK property-rich entities for disposals made by protected cell companies. For non-DOMs, if the conditions are met, those who have previously used the remittance basis, they can potentially get the CGT rebates in from the 5th of April 2017. The original proposal was that it was going to be from 2019, but this has subsequently changed to the 5th of April 2017. And the final point on this slide here is just about incorporation relief. So incorporation relief is a deferral relief when someone transfers their business into a company. And that deferred gain made companies rolled over and set against the base costs of that individual shares in the company now. Now, previously, you didn't have to make this claim, but from the 6th of April 2026, individuals and trustees are going to be required to make the claim for incorporation relief through their self-assessment tax return. So this is sort of a compliance-based point going forward. VAT. So the government's not going to be increasing the VAT rates or thresholds, and so that the VAT threshold is going to remain at 90,000, and the deregistration threshold is also going to stay at 88,000. There's been a long-running dispute between HMRC and some ride-sharing apps about the use of what's called the tour operators margin scheme, which wasn't originally intended for those to be using it. And they were basically, this was effectively reducing their effective rate of VAT. Now, from the 2nd of January 26, suppliers of the private hire vehicles and taxi services actually can be excluded from the scheme, except where they're supplied with certain other travel services. And there's no plan to sort of introduce any new margin scheme or reduce rate either for this sector. There's also going to be increase in penalties for late payments of VAT coming in from the 1st of April 2027. There's some good news for charities. So from the 1st of April 26, there's going to be new VAT relief available for business donations of goods to charity for onward distribution to those in need or in use in the delivery of charitable services. And there was a long consultation on this, so that's very much welcomed. The government's going to require all VAT invoices to be issued in a specific electronic format from April 2029. And this is going to be a big change, which is going to be comparable with making tax digital. And this will be a digital exchange of information between the supplier and customers' accounting systems for B2Bs. And so what this eventually will mean is that invoices sent electronically by email, such as a PDF, will no longer suffice. So this will be something that over the next couple of years, there'll be more information coming out, but it is worth starting to think about how this will be coming in. The government is also removing the customs duty relief on goods imported into UK valued at £135 or less, making them subject to customs duty from at the latest March 2029. And the government have introduced this to bring in fair competition between the high street businesses in the UK compared to online retailers who we have all seen have a rapid growth in the last couple of years. And the final slide is just two minor points on stamp taxes. So from 27th November 25, transfers of company securities will be subject to relief from the 0.5% of the stamp duty reserve tax for 3 years from the point that they list on a UK regulated market. And there's also going to be some modernisation of stamp duties as well, regarding a new security transfer charge, which will replace stamp duty and stamp duty reserve tax. But there'll be more information that will come out on this point very shortly. Yeah, thank you everyone for taking the time to listen to me today. I will hand you over to Aaron.
Thanks, Ben. So inheritance tax, yeah, I think there's been a fair amount of speculation about various inheritance tax changes that the government could implement. So let's have a look and see if any of those actually happened. So first up, inheritance tax nil rate band. That's been frozen for an additional year at 325,000. It's been 325,000 since 2010. So again, another example of fiscal drag. Value of assets going up, but tax thresholds not increasing in line with them. The residence nil rate band, this is an additional nil rate band that's available against the value of the main home where that's left to direct descendants. Well, that's also been frozen for a further year at 175,000. That residence nil rate band is actually tapered down by £1 for every £2 that your total estate before relief exceeds 2 million. That threshold is going to continue up until 5th of April 2031. However, the nil rate band and the residence nil rate band will continue to be transferable between spouses. So in theory, if a married couple can arrange their affairs correctly, they can have up to £1 million of assets and not pay inheritance tax on them. The inheritance tax rate remains at 40%. That's compared to an OECD average of 15%. So obviously our rate is quite a lot higher than many other countries. And I think this sort of combination of rising asset values and frozen thresholds has led to record receipts of inheritance tax, which I think are going to be about sort of 9 billion for 25-26. And the OBR expect IHT receipts to rise further to 14 billion by 29-30. Let's try and get this next slide to move along. Okay, there we go. So there's been a lot of speculation that the government might make changes to the IHT gifting rules. Thankfully, they've not made any changes to those. So the 7-year rule remains for the time being, despite speculation that could be extended to 10 years. So very broadly, if you make a gift to another individual, that gift will remain in your estate for 7 years, but after 7 years, it will fall out of your estate when calculating IHT. There is also a tapering relief rule. So if you survive between 3 and 7 years, the IHT is tapered. There was some speculation that the government might attack that, but they haven't. So that still remains in place, which is good news. They haven't touched any of the other exemptions either. So we've still got the IHT annual gifts exemption of £3,000. And also the gifts out of income exemption remains, which is good news. I know we've had a few questions on that have come through. And also there's a reduction in the IHT rate to 36%, where 10% of the net estate is left to charity. The government haven't touched that either, so that still remains. So some good news there that they've not attacked some of those exemptions, which helps people to sort of plan to mitigate their inheritance tax. And moving on to business property relief and agricultural property relief. You recall we sort of discussed this last year. In the 2024 budget, the government announced that the full 100% relief from inheritance tax for qualifying agricultural and business property was going to be capped at the first £1 million of value, with relief reducing to 50% above that, resulting in an effective 20% IHT on values above 1 million. Now, we all know that obviously the farmers have been sort of protesting about that, but more widely, it does also affect a lot of other businesses, a lot of owner-managed businesses could be worth more than £1 million that could be caught by this. Unfortunately, despite all the concerns raised on that front, there's been no U-turn. They're going to go ahead with this policy, with the 100% relief being capped at £1 million. However, one bit of good news is that the initial proposals didn't provide for that £1 million allowance to be transferred between spouses on death. And that would have meant a potential wastage if the entire estate was left to spouse and the spouse exemption applied. So what they've now announced that £1 million allowance will be transferable between spouses and civil partners on death. So that will avoid wastage of the allowance, reduce the need for deeds of variation to be done following death. So in addition to that, where the first spouse passed away before 6th of April 26, then their £1 million allowance will be available to the surviving spouse. So effectively, like a £2 million allowance there per couple. So that is good news. And also, it should be noticed there's also potentially a further £1 million allowance available for trust in certain situations. So I guess in theory, you know, if you're looking at a married couple and they each set up a trust, could you be looking at maybe 4 million that you can get 100% relief on? Would just sort of reiterate there that the rules on the trusts on that sort of trust planning are quite complex. So yeah, it's important you take sort of specialist advice for doing anything with trusts on that front. Okay. So just to touch on AIM shares. So as part of these reforms to business property relief, you know, they've also attacked AIM listed shares. So historically, you know, if you invested in AIM listed shares, own those shares for 2 years, you know, you could get 100% business property relief on the value of those shares. However, you know, the government are changing the rules on that. So from April 26, basically, you're only going to get 50% relief, 50% business property relief on AIM listed shares. And those AIM listed shares won't benefit from that £1 million allowance. So you won't get 100% relief on the first million. It's going to be basically 50% relief on the entire value of those AIM shares. So making those a lot less attractive from a planning point of view. Okay, now moving on to inheritance tax and pensions. So for many years, pensions and death benefits from pensions have not been subject to inheritance tax. Death benefits are usually paid tax-free if the individual dies under the age of 75. Death benefits paid when an individual dies over 75 are usually taxed at the recipient's marginal rate of income tax. Unfortunately, the government has decided to bring unused pension funds and death benefits payable from a pension into a person's estate for inheritance tax purposes from 6th of April 27. However, all death in service benefits paid from registered schemes will be excluded from IHT for these purposes. And in terms of the administration and collection of that, it'll be the personal representatives of the estate that are liable for reporting and paying that inheritance tax due on the unused pension funds. So quite a bit of additional administration there for personal representatives having to liaise with pension fund trustees and whatnot. And also another major point here is that, you know, whilst they're bringing the value of pension funds into inheritance tax, you're still going to have the situation where the beneficiaries will be subject to income tax on drawing pensions left by individuals that died over the age of 75. So, you know, you've got a potential effective tax rate there of 67%, where those beneficiaries are, say, you know, additional rate taxpayers. So that's a really sort of heavy burden there. And it's going to sort of force people to look into their current sort of plans and look at what they can do to sort of mitigate that. Again, just reiterate the importance of taking advice on that. And obviously in Hawsons, we can cover both the tax side and the financial planning aspects of that through Hawsons Wealth Management. So sort of get in touch with us if that's of concern to you. Okay, that's it from me. To pass over now to Stephen, who's going to cover employment tax. Thanks very much, everyone.
Thanks, Aaron. I'm going to try and catch up a bit of time here, so I'm going to sort of rattle through these. There's not major changes on most of these, so employment tax has been fairly stable this time. So national insurance. So I don't know. I'm sure everyone remembers last year we had major changes to national insurance rates. Employers' national insurance went up to 15%, and the level at which it started applying also substantially reduced. So I suppose positive news is that that's not changed any further, but it's not gone down. So we do have quite a large gap now between employees' national insurance, which is a top rate of 8%, and employer rate, which is 15%. So the employment allowance, that's still quite generous at 10,500. That's pretty attractive to the very smallest businesses. Just trying to move this on. There we go. Some minor tweaking around one or two, the level at which You need to have income in order to get a national insurance record for a particular year, and some increases in the voluntary national insurance rates. They're also clamping down on overseas people contributing into the system in order to get a state pension. So that's going to become more difficult going forwards. However, the national living wage, national minimum wage rates do continue to rise. So for the national living wage, that's a 50 pence increase, around sort of 4%. The rate for the 18 to 20-year-olds has increased by a lot more, nearly around 8%. And that's because they're trying to get that rate to align over time with the national living wage. So yeah, substantial increases there, maybe not quite as high as they have been in the past, but still substantial. And there's going to be a change that's now going to be enforced by a new agency, the Fair Work Agency, rather than HMRC, although I presume it'll be the same individuals, but just rebranded. Company car benefits, a little bit of tweaking. So zero emission cars, electric cars goes from 3 to 4%, and some other increases for low emission cars. There's also a bit of a change for plug-in hybrids. I understand their rating for CO2 emissions is changing, and to sort of offset that impact, there's some easement on their benefit in kind rates. Salary sacrifice and pension contributions. So this was widely sort of trailed before the budget, that there were going to be employers' national insurance on employer pension contributions, which would have been a massive impact really. But although they have brought in some changes, they are less problematic than they could be. They're only coming in for until April 2029, so we've got a little bit of lead time. But it's not all employer pension contributions, it's just those done through salary sacrifice. And there is a de minimis of £2,000 where you don't have that. So it's only sort of for the middle earners. Generally, people around sort of £40,000 upwards will see some impact of this. I mean, a lot of our clients, owner managed businesses, they do make substantial employer pension contributions from their companies. Doesn't sound as if they're necessarily going to be affected because they're not done through a salary sacrifice scheme. They're just an additional, well, just an annual contribution which is made. So we'll be interested to see the detail of that when it comes out. But at the moment, it doesn't look too bad. Just a couple of points here. So the revenue is still concerned about non-compliance in the umbrella company market. That's not people selling umbrellas. That's sort of agencies and so on. So they're still going to bring that in, and that's going to be from April. And again, they're also concerned about contrived car ownership schemes, not something which we've come across a lot. That was supposed to come in sooner, but it sounds like it's probably quite a difficult thing, so it's been delayed until April 2030. Couple of minor benefit in kind issues. So just bringing full exemptions for reimbursement of eye tests, flu vaccines, home working equipment. Those eye tests and flu vaccines wasn't really an issue before because it came under the trivial benefits exemption of £50, but it doesn't always come under that now. So they're just making that clearer, I suppose. The other thing which is a little bit unfortunate is employees have been able to claim tax relief for the cost of home working if they have to work at home, but that is being scaled back. Although employers can reimburse them, they can't, if there isn't a reimbursement, then they can't just claim a deduction for that, and that's from April 2026. The mandatory payrolling of benefits, that's quite a big issue, but that also has been delayed as something which is quite complicated. So yeah, just a quick word. If you do have any questions, please do put them in the Q&A box, and then we'll pick those up at the end. But I'll hand over to Charlotte, who's going to take us through some of the more interesting personal tax changes. Charlotte, you're on mute.
Oh, apologies for that. So I'm going to talk about the autumn budget and the impact this will have on your personal tax. So as anticipated, the basic, higher and additional rate tax thresholds will continue to be frozen until April 2031. So the fiscal drag is still ongoing. The tax rates on earned and pension income will remain the same for 26-27. So 20% for basic rate, 40% for higher rate, and 45% for additional rates. The basic rate threshold is also is 37,700, and individuals will pay additional rate tax on income above £125,140 for 26-27. Hopefully, from April 2031, these limits will be uprated in line with inflation. The personal allowance is also remaining frozen at £12,570 until April 2031, which is going to lead to more individuals paying tax as wages and pensions increase. The reduction in personal allowance when your income is over 100,000 remains the same, and when your income exceeds 125,140 pounds, your personal allowance will be fully withdrawn. Therefore, when your income is between 100,000 and 125,000, you are paying an effective tax rate of 60%, which is extremely high. Therefore, you may wish to look at methods in which to reduce your adjusted net income by making sure you're claiming your gift aid donations and potentially looking at pension contributions. As the thresholds and personal allowance have been frozen for a number of years now, more individuals are being charged a higher and additional rate tax than would have been previously. This has therefore led to a large amount of unclaimed high rate tax relief on personal or employee pension contributions. Therefore, it's worth ensuring that if you haven't really received the relief at source, that you have claimed it if it is available. The married couple's allowance and blind person's allowance for 26-27 will be uprated in line with inflation. So tax on property income, the current tax rates will be maintained for 26-27. So this is the 20% for basic rate, 40% for higher rate, and 45% for additional rate. From 27-28, a new rate of tax on property income will be introduced. This is a 2% increase on the current rate, so 22% for basic rate, 42% for higher rate, and 47% for additional rate taxpayers. However, they have confirmed that the finance cost relief will be provided at the separate property basic tax rate of 22% from 27-28. So tax on savings income. So the savings allowance are remaining the same. So if you're a basic rate taxpayer, the first £1,000 of savings income will be taxed at 0%. For higher rate taxpayers, this is £500, and no allowance is due for additional rate taxpayers. If the first £5,000 of your taxable income is savings income, then this may qualify for a 0% starting rate. So the current tax rate on saving income will be maintained for 26-27, so the 20, 40 and 45, depending on your tax bracket. However, for 27-28, a 2% increase on the current rates will be applied. So again, 22% for basic rate taxpayers, 42% for higher rate, and 47% for additional rate taxpayers. So tax on dividends. So the dividend allowance is remaining the same at £500. So the first £500 of dividends are taxed at 0%. The dividend tax rate is changing. However, it is changing earlier than the change on property and savings income. So the dividends tax rate is changing from the 6th of April 2026. And this is a 2% increase on the current rates for basic and higher rate taxpayers. So it's still good for basic rate taxpayers, as the tax rate is 10.75%, which is lower than the 20%. It goes up to 35.75% for higher rate taxpayers, and it's remaining the same at 39.35% for additional rate taxpayers. If you are intending to declare a dividend, then you may wish to look to do this prior to the 6th of April 26, because due to the lower tax rates. This could also be a good time to look at the remuneration planning, how you're drawing money out of your business, as it may well be that the remuneration via dividends is no longer the most tax efficient. This needs to be looked at on sort of a case-by-case basis, because it depends on the level of dividends you're drawing, if you state pension age, there's a variety of different factors, but definitely now would be the time to look at that. Following on from the increase in tax rates for savings, property and dividend income, the government has announced that the income tax ordering rules will change from the 6th of April 27. This means a personal allowance will be deducted from employment, trading or pension income in priority, as these will be taxed at a lower rate. Pension tax limits. The pension tax limits remain the same. So the annual allowance is remaining 60,000 for 26-27, but tapered if you are a high income individual to a minimum of 10,000. Is bear in mind that annual allowance does include both employer and employee pension contributions. The lump sum allowance, which is the general maximum that can be taken as a tax-free lump sum, is staying the same at £268,275. But pension contributions are still extremely tax efficient. So if you are interested in making some additional pension contributions, then I would always recommend seeking financial advice. So please do get in contact with a member of our Hawsons wealth management team. State pensioners. So in April 26, the state pension will be uprated by 4.8%. And following a few changes since the budget in 2024, the government has announced they will make the winter fuel payment to all of those of state pension age. However, individuals with a taxable income above 35,000 will be required to repay their winter fuel payment either through self-assessment or pay-as-you-earn for 25-26. There is the option to opt out of receiving the winter fuel payment. However, it is too late for the current tax year, but it might be something to bear in mind going forwards. Making tax digital for income tax. So after many years of delays, making tax digital is finally being mandated. For individuals with gross rental or self-employed income of over £50,000, this is turnover, not profit, they will be mandated to join making tax digital for income tax from the 6th of April 26. So therefore, obviously that is only 4 months away. So you do need to ensure that you have the relevant software to file the quarterly updates. If you're wanting our assistance, we'll be more than happy to assist with filing your quarterly updates. The quarterly update is just to report income and expenses. At the current time, the dates for paying your self-assessment tax are not changing. So, but you do, you have to just report the income and expenses. The government has announced they will not apply late submission penalties for quarterly updates during 26-27, as this is the first year of mandation. So they're aware it's going to be a big change for individuals who are not previously used to reporting quarterly. They've also announced that from the 6th of April 28, individuals with gross rental and or self-employed income will be mandated from the 6th of April 28. Reporting by third parties to HMRC. So online platforms which people use to sell goods and services are already required to report to HMRC regarding individual taxpayers. In the budget, the government have announced that UK crypto asset providers will also be required to report on their UK tax resident customers to HMRC. Therefore, if you've ever undertaken any crypto transactions, then you need to ensure these have been reported to HMRC, even if the amounts are minimal. Thank you ever so much for your time on this Friday morning, and I will pass you over to Ben Peacock from our Wealth Management Department. Thank you very much.
Thanks, Charlotte. So I'm going to talk about some of the key changes and how these are going to impact individuals from a financial planning point of view. So one of the things that took a lot of the headlines was the changes around the salary sacrifice pension regime. So I want to clarify a couple of common misunderstandings I've heard from clients or seen more generally. So despite the change, this is still the most tax efficient way to save for your retirement. What we've seen is a reduction in the benefit, not a removal of it altogether, and that's from April 2029 anyhow. So you can still contribute more than the cap and receive your income tax relief. The cap just refers to the amount at which you would receive the national insurance relief. So I think the impact of this has been overstated a little in the media. So for a basic rate taxpayer, for every £100 they contribute above that cap, that costs them an extra £8. And for a higher or additional rate taxpayer, that's an extra £2 for every £100 they contribute over the cap. So I don't think this materially impacts the merit of this as a strategy. And really, I don't think people sacrifice into the pensions for the national insurance relief anyhow. It's about saving for your retirement and in some cases the income tax relief. Stephen made an excellent point around employer pension contributions not made via salary sacrifice. So a really common scenario we see at Hawsons are directors and owner managed businesses choosing to remunerate themselves through a single pension contribution. What it looks like from the early detail we've had is that there will be no change with regards to national insurance in that area. We also saw some changes in the ISA regime. From April 2027, under 65s are capped at saving 12,000 into a cash ISA each tax year. So the idea here is to encourage people to invest. It's an endorsement of the idea that over the long term, investing is the best way to grow your wealth and even to maintain its value in real terms. I don't think this is going to materially impact investor behaviour. You know, the average cash ISA funding is less than 7,000 anyhow. There was some pre-budget research done and it suggested most people, if faced with a cap, would just hold cash anyway, but outside of the ISA environment. If anything, I think it's going to incentivise people to use a cash ISA in the short term. I think it'll invoke that scarcity mindset. I'm going to use it while I can. And that's the exact opposite of the policy's intention. There was also a consultation announced on replacing the lifetime ISA. So this is a product aimed at first-time buyers really, and also people saving for retirement. The awareness of this was pretty poor. The uptake even worse. It's not quite British ISA levels of poor, which never saw the light of day, but as a policy, it was a failure. So I expect we'll see in due course a change and something to replace this to provide an encouragement for people trying to get on the property ladder for the first time. One final thing I wanted to highlight was a change there was some speculation around that we didn't see. So as Aaron outlined, that there is a £1 million per individual allowance for business relief or agricultural property relief qualifying assets or investments. For people who don't hold those, you could access these investments via a product. And this was attractive for people because providing you held it for 2 years, it would be exempt from inheritance tax. There was some speculation this would be aligned with the changes to the AIM market, so in effect receive 50% relief, or perhaps have the relief removed altogether. So I was quite relieved that there wasn't any change in this area, and I think for a lot of people keen to mitigate their estate for inheritance tax purposes, this remains a good option. I'm now going to hand it over to Stephen, who's going to chair our question and answer session.
Thank you, Ben, for that. Yeah, I don't want to overstay our welcome here, so I'll probably just cover off a few little things and sum up really, because we're pretty much up to our time. There was a question. There's been quite a few questions about particular issues around pensions, but I think they're quite specific. So it's probably best if those people contact us separately, and then we can just pick those up individual on individual basis. But yeah, I did get one question. Will the budget help small and medium-sized firms and stimulate the economy? Which I thought was a good question, but probably a little bit outside my expertise, quite a wide subject. I'd say my personal views on balance, this is probably a sort of a neutral budget. it didn't really have massive positives for small businesses, but then not too many negatives, apart from sort of some ones around the edges. But I think in the context, we have to put it in context, and last year's budget, I think, really did hit businesses, small businesses and their owners very badly, with the changes in reductions in business property relief, increases in national insurance and increases in capital gains tax rates. So I think in the context of that, this was quite a neutral budget, but last year it hasn't really reversed some of those big negatives from last year. So yeah, I think there's a little uncertainty around things at the moment, and that's probably going to continue. So I think we'll wrap it up there. But yeah, if you've got specific questions, I know some of you have raised things, then please just get in contact with us, and the most appropriate person will come back to you on those. Well, all I can say is thank you for joining us, and enjoy the rest of your day. Thank you very much.
Thanks, everyone.